Hey everyone, and welcome to the Deep Dive. Today we're diving deep into a topic that's both fascinating and a little bit scary: Ponzi schemes.
Uh-huh.
These schemes have been around for over a century,
Yeah.
but they still manage to trick people, even sophisticated investors.
Right.
And today we're going to find out how they work, why they're so dangerous, and most importantly, how to spot them.
And what's really interesting about Ponzi schemes is how they tap into that basic human desire.
Yeah.
Wanting to make a lot of money
Of course.
quickly and easily. Who doesn't want that, right?
Right. And that's why they can be so tempting. So let's start with the basics. What exactly is a Ponzi scheme?
Okay, well, in the simplest terms, a Ponzi scheme is a type of investment fraud where returns for early investors are paid out from the money from new investors,
Okay.
not from any actual profit. So picture this, like a scheme that promises like a 10% return every month.
Oh, wow.
Sounds pretty amazing, right?
Yeah. Too good to be true, probably.
Exactly, and that's the catch. They use the money from new recruits to pay off those early birds,
Okay.
creating this illusion of incredible success.
Ah, I see.
The problem is it's totally unsustainable.
Yeah. Eventually you run out of new people, right?
Precisely.
So it's kind of like building a house of cards.
Yes, it's a perfect analogy.
Looks impressive for a while, but eventually it's all going to come crashing down.
Exactly. The new money dries up, or too many people try to cash out all at once.
Right.
And the whole thing crumbles, leaving a trail of victims behind.
And we've seen some high-profile cases, right? Like Bernie Madoff, wasn't he the guy behind the biggest one ever?
Bernie Madoff, yeah, he was the mastermind behind the largest Ponzi scheme in history. He defrauded investors of an unbelievable amount of money.
How much was it?
$65 billion.
65 billion.
Yeah, it's hard to even fathom that amount.
That's insane. It's almost more than some countries' GDPs.
It really is.
Wow. So how do these schemes, how do they manage to fool so many people? Especially, even smart investors get caught up in these things.
Right. Well, it's all about creating this very carefully crafted illusion.
Mm.
They often use really complex jargon or claim to have some secret proprietary strategy that allows them to achieve these crazy high returns.
So they try to make it sound really exclusive and like you're in on something special.
Exactly. And they might even target specific communities
Okay.
where there's already a high level of trust.
So they exploit that trust, basically.
Exactly. It becomes almost like a secret club,
Yeah.
where members feel privileged to be a part of this special opportunity.
Makes sense.
And to make it even more convincing, they actually pay off those early investors,
Right. So it seems legit.
creating that buzz, that legitimacy.
So it's like a self-fulfilling prophecy in a way.
Exactly.
Those early investors are actually getting paid. So
Yeah.
they become almost like the scheme's best salespeople
They're the best sales,
without even knowing it.
unwittingly spreading the word, attracting more victims to this scheme.
Right. And it just keeps growing and growing.
Yeah, it snowballs.
Till it can't anymore, right?
Yeah, exactly. It's all smoke and mirrors.
Yeah.
There's no actual business or investment strategy generating those returns.
Right.
It's just moving money around.
Robbing Peter to pay Paul.
That's exactly it. Yeah, the money is not being invested in anything real.
Mm-hmm.
It's being used to keep up appearances and
Right.
keep the scheme going for as long as possible.
And that's why they all eventually collapse, right?
It's just a matter of time.
Okay. So we understand how they work, why they're so dangerous, but how can we spot them? What are some red flags to look out for?
Well, first and foremost, if it sounds too good to be true,
Yeah.
it probably is. High returns with little or no risk, that's a major red flag.
Right. Like if someone's promising you guaranteed returns of, let's say, 20% per month,
Yeah,
you gotta be suspicious.
that should raise some serious eyebrows. Legitimate investments, they just don't work that way.
Yeah, you gotta be realistic. There's no such thing as a free lunch, especially in investing.
Exactly. Another red flag is when the investment strategy is vague or super complicated.
Oh, okay.
If you can't understand how the money is being made, or if it's all shrouded in jargon,
Yeah.
that's a sign to be careful.
So don't be afraid to ask questions. If something doesn't make sense or seems too good to be true,
Yeah.
trust your gut and do your research.
Absolutely. And watch out for high-pressure sales tactics.
Okay.
If you're being pressured to invest quickly
Mm-hmm.
before you've had a chance to really think it through or do your research, That's another warning sign.
It's like those, those friends that are always trying to get you to join their multi-level marketing scheme?
Yeah.
They're always pushing you to join and saying, you'll miss out if you don't act now.
That's a great analogy.
Yeah.
Ponzi schemes often use that same kind of urgency, that fear of missing out,
Yeah.
to lure people in. They want you to make an emotional decision, not a rational one.
Right, right.
And another red flag is difficulty withdrawing your money.
Oh, okay.
If there are delays or excuses when you try to cash out,
Yeah,
that's a big problem.
that's a really bad sign.
Yeah, it's your money. You should be able to access it whenever you need it.
Exactly.
And if there are roadblocks or the process is too complicated,
Yeah.
that's a major red flag.
So it's all about access and transparency.
Exactly. And it's important to remember that these schemes rely on a constant flow of new money.
Right, to keep the illusion going.
Yeah, so when people start asking for their money back,
Yeah.
it can trigger a wave of withdrawals that leads to the collapse.
So it's like a domino effect.
Exactly. It all comes crashing down.
Okay, so those are some general red flags to watch out for, but let's look at a specific example, a really big one that shook the financial world, Bernie Madoff. His name's almost synonymous with Ponzi schemes now. Can you give us a bit of background on his operation and how he managed to pull it off for so long?
Yeah, Bernie Madoff, he was a Wall Street veteran,
Yeah.
a seemingly respected figure in finance.
Yeah, he had this aura of, like, success and exclusivity around him.
Right?
People were, like, begging to invest with him.
It was like he was a celebrity.
Yeah, people were drawn to his reputation, his connections,
Yeah.
and this idea that, investing with him was a sure thing.
Yeah, he cultivated that image very carefully, targeting wealthy individuals, charitable foundations,
Wow.
even pension funds. He promised them consistent, above-market returns.
Right.
But it was all a lie.
Yeah.
He was using money from new investors to pay off the old ones.
Wow. And it worked for how long?
Decades.
Decades. That's incredible. How did he manage to keep it going for so long?
Well, several factors played into his success, unfortunately.
Mm-hmm.
First, his reputation and connections gave him a veneer of legitimacy.
So people trusted him because of who he was,
Right.
not because they understood what he was actually doing.
Yes. Second, he preyed on people's greed,
Yeah.
that desire for easy money. He offered something that seemed too good to pass up, and people were willing to overlook those warning signs.
They didn't want to miss out.
Right, FOMO.
Yeah. The fear of missing out.
Exactly. And third, he kept his operation very secretive,
Okay.
using complex financial instruments and avoiding regulatory scrutiny.
So it was hard to track what he was actually doing.
Very difficult for outsiders to understand.
So it was a combination of deception, exploitation, and a lack of transparency that let him operate under the radar for so long.
Precisely. And it wasn't until the 2008 financial crisis,
Oh, wow.
when investors started asking for their money back,
Yeah.
that the whole thing fell apart. Madoff was arrested, and the true scope of his fraud was revealed.
Leaving thousands of investors with huge losses.
Devastating losses.
It's a cautionary tale for sure.
Yeah.
And while Madoff's scheme was particularly egregious, it's important to remember that these schemes can take many forms.
Right. They're not always orchestrated by, Wall Street big shots.
Exactly. They can happen in any industry at any level, and they often target specific communities or groups where there's that high level of trust.
That's an important point. And in fact, the scheme that actually gave this type of fraud its name
Oh, right.
wasn't some high-flying financier, but a relatively unknown Italian immigrant named Charles Ponzi.
Charles Ponzi, the OG Ponzi schemer.
Exactly.
Tell us a little bit about his operation. What was his big idea?
His scheme was actually pretty simple, at least on the surface. It revolved around international reply coupons, which were used back then for prepaying postage for international mail.
Oh, so before email and instant messaging, people were sending physical letters across the globe.
Right, exactly.
Why?
And Ponzi, he noticed a difference in the exchange rates for these coupons between countries.
Okay.
He claimed he could buy these coupons cheaply in one country and sell them for a profit in another,
Okay.
promising investors a 50% return in just 45 days.
Wow. Sounds tempting, but I'm guessing there was a catch.
Of course,
Of course.
there was no actual arbitrage opportunity.
Oh.
He was just using money from new investors to pay off the earlier ones.
So the same basic principle as Madoff.
Yeah,
Just
right.
a different product, basically.
Different packaging, same idea.
Yeah, different wrapping paper, same bat gift.
Exactly. And just like Madoff, Ponzi's scheme eventually collapsed,
Yeah.
leaving investors with massive losses. But his name, It stuck.
It became synonymous with this type of scam.
Exactly. Forever linked to this kind of financial fraud.
So from international reply coupons to complex financial instruments, the methods might change, but the underlying principle of a Ponzi scheme remains the same: using money from new investors to pay off the old, creating this unsustainable cycle of deception that ultimately implodes. Now, knowing how these schemes work is just the first step. The real key is learning how to spot those warning signs and protect yourself from becoming a victim.
Absolutely. Awareness is key. And in the next part of our deep dive, we're going to give you the knowledge and tools you need to navigate the financial landscape with confidence and avoid those tempting traps.
Sounds good. We'll be right back.
It's amazing how much the world of finance is changing,
Yeah, it's constantly evolving, right?
Absolutely. New trends, new technologies, new risks to consider.
Yeah, and I feel like one of the biggest game changers recently has been AI.
AI. Oh, yeah, for sure.
Artificial intelligence. I mean, it seems like it's everywhere these days.
Everywhere.
And finance is no exception.
Definitely not. It's being used for everything now.
Yeah.
From fraud detection and risk assessment to algorithmic trading and personalized advice.
Yeah, and it's exciting, but it also comes with its own set of challenges, right?
It does.
Like, how do we make sure these AI algorithms are fair?
Right.
And what happens if they start making decisions that we don't understand or can't control?
That's a big question.
It's a little bit unsettling, honestly.
Yeah, it's like opening a Pandora's box, right? It's got all this potential, but also potential risks.
Definitely. And speaking of new trends, we can't forget about sustainable investing.
ESG.
ESG, exactly. More and more investors are considering the environmental and social impact of their investments.
Absolutely. It's not just about profits anymore.
Right. People want their money to do good in the world.
They want to align their investments with their values.
Exactly. But how does ESG tie into risk management?
Well, ESG factors can actually have a big impact on a company's long-term sustainability and profitability.
Oh, interesting.
For example, a company with bad environmental practices, they might face fines or lawsuits
Oh, right.
or damage to their reputation,
Yeah, that makes sense.
which can hurt their bottom line.
So it's not just about doing good, it's also about making smart investments.
Exactly. By considering ESG factors, investors can identify both risks and opportunities.
I see.
They could potentially improve their returns and make a positive impact at the same time.
So it's like a win-win.
It's a win-win. Absolutely.
Okay, so AI, ESG, these are some big trends shaping the financial landscape. But we can't forget about good old-fashioned market volatility.
Right.
It seems like we're living in a time of constant uncertainty,
It does feel that way.
which can make markets go a little haywire sometimes.
For sure.
How can we stay grounded and make rational decisions when the market is going crazy?
Well, the key is to have a plan, a solid investment plan,
Okay.
and stick to it. Figure out your goals, your risk tolerance, and your time horizon before you even think about investing.
Right, so don't just jump in head first.
No, don't let those short-term fluctuations derail your long-term strategy.
Yeah, it's like having a roadmap to
Exactly.
guide you through those turbulent times.
Absolutely. And diversification. We talked about that earlier.
Right, not putting all your eggs in one basket.
That's crucial. Spread your investments across different asset classes,
Yeah.
like stocks, bonds, real estate, to create a portfolio that can weather those market storms.
It's like a balanced meal for your finances.
I like that. A balanced meal, yeah.
Yeah.
Providing nutrients from various sources to keep your financial health strong.
Exactly. And remember, market downturns are normal.
They're a natural part of the cycle.
Yeah, they can even create opportunities.
Absolutely. You can buy undervalued assets and potentially improve your returns over time.
So it's about looking past the short-term ups and downs and focusing on the long game.
Precisely. That long-term perspective is key.
Okay, so we've talked about market volatility, but we can't ignore geopolitical risks either, right?
No, those are a big factor.
Global events like political instability, trade wars, pandemics,
Yeah.
they can all have a huge impact on financial markets.
Absolutely. They can send shockwaves through the system.
It feels like every time we turn on the news, there's another crisis happening somewhere.
It does. Yeah, it's a lot to keep up with.
So how can we stay informed and make good decisions in this environment?
Well, staying informed is key, obviously.
Right.
You've got to understand how global events might affect the economy and the markets.
So it's not just about following the financial news, it's about understanding the bigger picture.
Exactly. You need that broader context.
Okay.
And while you can't predict the future,
Right.
you can try to anticipate potential scenarios and adjust your strategy accordingly.
So be proactive, not reactive.
Exactly. For example, if you see tensions rising in a particular region,
Yeah.
you might want to reduce your exposure to investments in that area.
Oh, that's smart.
Or if you anticipate a policy change that could affect a certain industry,
Yeah.
you can adjust your portfolio accordingly.
So it's all about being flexible, constantly reassessing the landscape and making adjustments as needed.
Precisely.
And remembering that markets tend to recover over time.
They do, yeah. Those short-term fluctuations are often just noise.
Right, it's about not panicking.
Exactly. Don't make impulsive decisions based on fear or emotion.
Yeah, stick to the plan and ride it out.
Exactly.
Okay, so we've covered a lot of ground here. From AI and ESG to market volatility and geopolitical risks, it seems like there's a lot to think about when it comes to managing risk.
There is, but it's all connected.
Is there like one big takeaway that ties all of this together?
I think the key takeaway is that risk management is not a one-time thing. It's an ongoing process.
So it's a continuous cycle of learning, adapting, and refining.
Exactly. It's about embracing the fact that risk is part of investing.
Right. It's not something to be afraid of.
No, it's something to be understood and managed.
So it's about turning risk from a potential threat into a potential opportunity.
Precisely. And remember, in the world of finance, the only constant is change.
That's a great point. Well, we've explored the world of Ponzi schemes, those cautionary tales of financial deception, and we've delved into the broader landscape of risk management in finance. Now, armed with this knowledge, let's shift gears and explore some practical strategies for building a resilient financial future, one that can withstand any storm. Join us for part 3, where we'll get tactical and equip you with the tools to take control of your financial destiny. All right, welcome back to the deep dive. In parts 1 and 2, we explored the world of Ponzi schemes and the constantly changing landscape of risk in finance. Now, in this final part, we're shifting gears. We talked about defense. Now let's talk about offense.
Yeah.
Building a financial future that's not just stable, but resilient.
Like building a financial fortress, capable of withstanding any storm.
Exactly.
Right.
So where do we start? What's the first step?
Well, the foundation of any good financial plan is a budget.
Back to basics. We're talking about tracking our income and expenses, really knowing where our money is going.
Exactly. Understanding your cash flow, what's coming in, what's going out,
Right.
and where it's all going. Once you have that clear picture, you can start making smarter decisions.
It's like putting on financial glasses, you know?
Yeah.
Suddenly you see all these patterns you might not have noticed before.
And a budget isn't about restricting yourself.
Right.
It's about making conscious choices, prioritizing your spending, maybe cutting back in some areas so you can reach your financial goals.
It's like having a financial GPS guiding you toward your destination.
Absolutely. And speaking of unexpected detours, another essential element is an emergency fund.
Our financial safety net for those unexpected expenses, car repairs, medical bills.
Exactly. Life throws curveballs.
Yeah.
And having that cushion can make all the difference.
So you're not scrambling, you know,
Exactly.
if something comes up.
It's about peace of mind.
So how much should we aim for in our emergency fund?
Well, depends on your situation. But a good rule of thumb is 3 to 6 months of living expenses
Okay.
in a readily accessible account.
So you can get to it quickly.
Exactly, if you need it.
It's like that extra layer of protection, a financial airbag
Yeah,
that can deploy when you need it most.
precisely. And while an emergency fund is for those unexpected internal shocks, we also need to think about external factors that can impact our finances.
Right, like things we can't control.
Exactly.
Okay.
And that's where insurance comes in.
Insurance, right. It's about transferring risk.
Yes.
Paying a small amount to protect ourselves from bigger losses.
Precisely. Whether it's health insurance, car insurance, homeowners insurance, it's about having that safety net.
A financial shield.
Exactly.
Protecting us from those unexpected blows.
And once we have those basics covered, we can start thinking about building wealth through investing.
All right, so we've built our fortress.
Yeah.
Now it's time to furnish it.
Make it grow.
But investing can be intimidating. Where do we even start?
Start with your goals, your risk tolerance, and your time horizon.
Okay, so what are you hoping to achieve?
Right. How much risk are you comfortable with?
Yeah.
How long are you investing for?
So it's not about getting rich quick or following the latest trends?
No, it's about a strategic, long-term approach.
Right.
And diversification is crucial.
Not putting all our eggs in one basket again.
Exactly. Spread your investments across different asset classes.
Stocks, bonds, real estate.
Yeah. Even alternative investments.
Okay, to minimize our exposure.
Exactly. And don't be afraid to seek professional guidance.
Yeah, like a financial advisor.
A financial advisor can create a personalized plan for you.
It's like having a coach
Yeah.
helping you stay on track.
And making sure your investments align with your goals.
So building a resilient financial future,
Yeah.
it's a journey, not a destination.
Exactly.
It's about making informed decisions, staying adaptable,
And always learn.
always learning. All right, well, this deep dive has been a whirlwind tour of the financial world. We explored the dark side with Ponzi schemes, those cautionary tales of deception, and we learned how to identify those red flags.
Yeah.
And then we shifted gears to focus on building a fortress of financial resilience.
With budgeting, emergency funds,
Yeah.
insurance, and wise investing.
And seeking guidance when we need it.
Absolutely. It's all about empowering yourself.
Exactly. And we hope this deep dive has given you the knowledge and the tools to take control of your financial destiny.
Don't be afraid to ask questions.
Yeah.
Seek advice and make informed decisions.
Knowledge is power. And in finance, the more you know, the better.
Absolutely.
Thanks for joining us on the deep dive. We hope you enjoyed this exploration of Ponzi schemes and strategies for building a resilient financial future. Until next time, stay curious and keep diving deep.